we were trying to understand how do we arrive at the discount rate. Okay, fine. So how many students were not there last class? Just raise your hands. Shruti तो होती नहीं हमेशा. You are also not there. You are also not there. Last class में तो थी तुम. जो नहीं थे, just raise your hand. Okay, fine. So what we are doing is basically that we are trying to understand, when we do intrinsic valuation, we require certain, information regarding, because we had to calculate the present value of cash flows. Okay, fine. So whenever we are trying to value a company, first we have to project how much cash the company is going to generate in future. Okay, so once we have done that, which I am going to teach after that, after the discount rates, how do we project the cash flows? That's the second part of our understanding. The first part is how do we discount those cash flows, because we are going to calculate the present value of all those cash flows to arrive at the value of the company. Okay, so there is a two process. Remember, always two process. First process, project the cash flow of the company. How much cash the company is going to generate in future. Any company like Reliance, Wipro, Tata Motors, Unilever or HDFC, whatever. Okay, fine. So whatever company you're trying to find out what should be the intrinsic value of that company, what should be the real value of the company, because the value which is given by the stock exchange is not always going to be the correct one. Okay, the market never values the stocks at its fair value or at its true value or intrinsic value. Either it is overvalued or undervalued. Whenever we look at the stock exchange, the rates, they are not the right rates. Okay, either they are too expensive or they are too low. Okay, so that means there is some value which is called the intrinsic value, the real value of a stock. Okay, so whenever we are trying to buy a stock, first we should know what is the intrinsic value. If the intrinsic value is lower than the value which is given the stock exchange, you should buy it. Okay, and if the intrinsic value is more or less rather, then we should not buy it. Okay, because the stock is expensive in the stock exchange. Is that okay? Fine. So, so the purpose is that all the analysts, because when you will be working with companies, so most of the companies, the investment banking companies and the financial analysis, their job is to recommend, what price you should buy. And if you buy a stock, how much it will go up further. Okay, and you are going to be part of the team. So it's a very important process that you must know. How do we find the intrinsic value? So it's a very difficult one, and not so simple, and not even so difficult also. You can always find the value, but whether you arrive at the right value or not, that needs to be, find out. Okay, so the first job is that you suppose you are trying to find the value of Reliance. Okay, now Reliance is a conglomerate. You all know. It is present in 6 kinds of businesses. Okay, oil to chemicals, oil to petrochemicals, oil exploration and oil to chemicals. There are 2 kinds of oil businesses of Reliance, and then they are present in Reliance Jio. What else? Reliance ka koi business or? Just name any business, even whether I talked or not. Retail. So Reliance is present in retail, number 1. Reliance is present in Jio. Reliance is going to be there in energy. Okay, so Reliance is about in 6 businesses. Okay, so it's a conglomerate. So the first job would be how the company is going to perform in future. So you're going to calculate what will be the revenue of the company if all the 6 verticals. It's a tough job because it's a big company and a conglomerate, almost a turnover about 10 lakh crores, which is the biggest company in India in terms of turnover, top line. Okay, biggest private company in terms of market cap. So you have to forecast how much they are going to generate revenue from oil businesses, retail businesses, their telecom businesses. Okay, once you have done that, you have to just find out how much they are going to earn in future. Okay, so for at least a foreseeable future, like for 5 or 6 years, you have to make a projections. How the sales is going to go up. Fine. Like suppose you are going to project the business of Reliance Jio. So how many subscribers they are going to add, how much they earn per subscriber, what will be the growth rate in terms of adding subscribers, what will be the cost assumptions. So you calculate the net profit and everything of the company. So all that you have to do for all the verticals. Okay. So once you have done, then you calculate the cash, how much cash the company is going to generate, and there is a mechanism through which we can convert the profit into cash. Okay. So once you have done that, then you are going to apply the cost of capital of the company, the cost of equity, the discount rate. Okay, fine, because the company is financed not only from equity but from debt also. So there is something called weighted average cost of capital, WACC. Have you heard of the name WACC? WACC kabhi suna hai? Weighted average cost of capital. So you have to arrive, ultimately today we are going to understand how to arrive at the weighted average cost of capital of any company. Okay. So once you have arrived at cost of capital, then you are going to discount all the cash flows of Reliance, okay, using the WACC, and arrive at the value of Reliance. Okay. And then divide by the number of shares of Reliance, so that you arrive per share value, and that value will be called intrinsic value. Okay. Then you compare that value with the stock exchange. If you find that Reliance is worth more than the value which is given by the stock exchange, suppose it is trading at around 1350 or 1400 and your value is coming to about 1800, so that means Reliance is worth buying it. Okay. Because according to your calculation, Reliance should be 1800 and not 1400 at which it is trading. Okay. Fine. So you will give a recommendation for people to buy Reliance. Okay. So today we are understanding the process of how to arrive. Now what we have done is that we have in the last class we arrived at cost of equity. Okay. So now we will move little further, and those students who have not attended, so they can so if I have to make it a full ना ये स्लाइड को फुल शो करना है तो कैसे करना पड़ेगा? आई एम फाइंडिंग इट डिफिकल्ट. ये पहले कभी आया नहीं ऐसा.
सर इसमें मतलब आपको स्पीकर नोट देखना है?
नहीं, मुझे तो पूरा करना है, मतलब फुल स्क्रीन करना है. Thank you. So cost of equity, fine. So last time we did cost of equity, okay, and we did an example also. So I'm just skipping that. So please watch my video if you have missed out the lecture how to calculate the cost of equity. But I'll just do a little recap. Maybe after done something, moves out further. Now, okay. So the weighted average cost approach. So ultimately, we have to find out the weighted average cost of capital. Now, a company, for example, may be using, suppose just imagine a very simple case. A company is, using 100 crores of capital. 50 crores of capital it has taken on debt, 50% equity. A company is doing business. Please listen. It's a very easy example so that you understand weighted average cost of capital. Suppose a company is doing business with 100 crores of capital. 50 crore it has taken from the shares, from the capital, share capital, from the shareholders. 50 crores it has taken a loan from the bank. Okay. Now share cost of equity, according to the approach which we discussed last time, suppose it comes to around 15%. Okay. Suppose the cost of equity is 15%. Okay. Fine. Okay. And suppose the company has taken debt at the rate of 10%. Okay. Fine. Okay. Just we are not assuming any income tax benefit. So what will be the weighted average cost of capital? Just try to calculate in your mind. Agar suppose if Reliance is doing business and just, the girl from Uttarakhand, kya naam hai? Huh? Swati? Swasti, jo bhi hai. Anyway, so I am asking you a question. Just think it's a very simple, maybe Shruti also. Suppose a company is doing business with 100 crores. 50 crores borrowed capital, 50 crores money taken from the shareholders. Suppose the cost of equity for the company is 15% and the loan which company has taken is at 10%. So what is the weighted average cost of capital? Just no need to just speak, है ना? अच्छा क्यों आप बोल रहे हो तो I am able to hear. Rashika, I am getting your voice in my this thing. So just Shruti, कैसे क्या capital होनी चाहिए? 100 crore, 50 crores from equity, okay? Fine. And what is the cost of equity? 15%. So for 50 it will be 7.5. 15 का आधा हो गया 7.5 और उधर जो 50 करोड़ लिया हुआ है वो 10%, उसका भी आधा हो गया 5 और 7.5 कितना हो गया 12.5%. So the weighted average cost of capital is how much? 12.5%, isn't it? Suppose the company is using 50% equity and 50% debt, and equity is costing 15% and debt is costing 10%, then weighted average cost of capital will be 12.5%. Isn't that not easy, Shruti? Asan hai na? So why you got lost? Okay. Sometime you get lost. Okay. Fine. So the most widely used approach to estimating the cost of capital involves estimating the cost of non-equity components like debt, okay, including debt and preferred stock. Now company can have loan from the bank, company can issue even preference shares, okay, instead of equity shares, in addition to the cost of equity and taking a weighted average cost of the cost. So that is what we did, okay. In this subsection we considered first the cost of these other components and then the weighting mechanism for estimating the cost of capital. So पहले हम क्या करेंगे? We'll understand the cost of debt and cost of preference shares. Cost of equity we have already done, okay. Now we are moving on, how do we calculate cost of debt? So all those students who are not there, please listen, because I am going to keep asking questions. Those students who are absent, particularly you two, you were also not there? You were there last time? Who was also not there last time? आप भी सुनिए, okay, I am going to ask questions. You were also not there? There? Okay. So बच गए फिर आप. Okay. Now, to estimate the cost of funding that a firm raises, we have to estimate the break.